So it is my favorite time of month. This is my favorite show of the month when Larry Goldberg and I take a look at what Cathie Wood had to say on Employment Friday. So Larry, how you doing? You're over still in France?
I am still in France and enjoying splendid weather today.
Oh, that's good.
The
I'm
first time for the first time since we're here. Well,
Oh,
maybe
really?
the first hour. Yeah, so we have this apartment, well, this I guess eerie on top of this beautiful old 17th century building that's been beautifully rehabbed. We're up in the eaves. We have this incredible view of this beautiful valley, all lovely, with incredible sunrises and incredible sunsets. And my wife's working away in the studio. She's here on an art residency.
Right.
But the weather has not been great. But right now it is really great, and we can take absolute advantage of this incredible view and this incredible we've got a beautiful I guess open ceiling, actually, or open roof on the one side, looking at the sunrise and the valley, and then on the other side we've got the same thing but looking across at the sunset and the valley.
Nice. That's really fantastic.
Yeah, but today we really had fantastic weather. It hasn't been that bad. I can't complain. But
yeah.
I'm the house husband, so
Yes, of course. All right. Well, I'm coming from Freeport, Maine, and we are having pretty okay, a little overcast, but not bad weather today. Anyway, Cathie Wood is just really wanting that recession to come. So let's take a look. She's been pushing for this recession and pushing for this recession. So let's see if we can either agree with her or disagree with her, or where we come up at the end of this set.
Well, I have to say that, I've been in Cathie's camp for some time, and we keep hearing how, oh, it's going to be a soft landing. Oh, it's going to be a soft landing. Oh, it's going to be a soft landing. And, as usual in these things, there's evidence to be found on both sides.
Sure.
But I think it's very important to follow what Cathie has to say. And she starts with a slide. And, I would love our listeners to actually go and listen to the whole Cathie presentation, because she's fantastic. But it's really interesting to give our own perspectives and to, share them, and to have our audience really weigh in as well in the comments. So we'd be very interested to hear, because this is important. This is going to really lead to our next several years, and it's a very important. And here we start with
and Larry, that you just made a super interesting comment. I think it's worth addressing. I think that you and Cathie and I would all be in 100% agreement that recession, soft landing, no landing, whatever happens in the next, say, 6 to 12 months, the future is bright. Beyond that recession, beyond that soft landing, whatever it happens there, whatever it turns out to be, because of AI and some of the other things that are happening, the positive is the 1990s are likely to repeat, I think, would be the way Cathie would say it.
She would, and I think that's going to be the wrap up. There's no doubt that Cathie has a very optimistic outlook, as do we.
Right.
Because we share with her the view that some of the inventiveness and some of what is happening, not only in AI, but in EVs and in robotics and in a whole range of new technologies, are going to be the spur to the next great wave of growth.
Right.
But, the last great wave of growth started with a very deep recession. But here's the fact of recessions. They're short,
Right,
very seldom long. The 70s, the 70-80 period was an anomaly, but it was because of a massive change
right.
in the global economic structure. And, you know, we could well have that again. And she touches on that. But we start with, you know, this whole idea that, you know, the money supply leads inflation by 18 months, give or take. And we see on this slide, she has, you know, the money supply in the bluish shade, and the CPI, that's the price index, consumer price index, in the green shade, in the green line.
Uh-huh.
And we see that, you know, that they've kind of shadowed each other, because the green line is, of course, delayed by 18 months, or the blue lines move forward by 18 months. So, move backwards by 18 months. So you see that the two really correspond, and the money supply really, and the green line has followed the actual cost price index has followed the blue line. So we see the blue line rising, and we see the green line, you know, accordingly rising accordingly as well.
Well, so my understanding of this would be that because the purple line is 18 months ahead, this is not real time. This is an estimate of future time. No, I'm sorry. This is real time.
Real time.
CPI is being laid on it in terms of its real time 18, which the effect is 18 months ahead. So
Yeah.
in this particular case, what we would see, what she was suggesting, I think, is that we would see continuing deflation over this next period. But then at the bottom, we would start to go back, not necessarily into inflation, but at least the deflation would end, and you would go back up to, maybe it might be that 2%, but basically another 6 months or so, 8 months or so of deflation, followed by a correction.
Yeah, and you know, I have added my own slide here.
Okay.
And my own slide is the velocity of money.
Right.
So it's a lot more complicated than just looking at money supply, because inflation inflation and or deflation is a function of money supply times the velocity of money. You can have all the money supply you like in the world, but if people are not actually exchanging goods and services, it's not going to have an inflation, it's not going to have any effect at all. So money, M2 is the actual velocity of money, the rate at which money changes hands.
Yes.
For goods and services. And if you have money supply rising and you have M2, that's money supply, if you have, if you have actual money supply rising and you have the velocity of money rising, then you're going to get, you know, a strong inflationary impact. And if you look at these numbers, the money supply has been rising consistently since 2022, tapering a little bit, but it's been rising. And actually, it's not nothing.
Right.
It's actually quite significant. It's risen from 2022, it was, you know, 1.15, which is virtually nil. And we're up at 1.35. So I think the inflation factor is a little bit higher than Cathie has made it out to be. And I would be a little concerned about it. I really would.
Yeah.
Now,
she's
there are other factors.
Yeah, I'm sorry. She's going to point to housing, auto sales, and rental housing, auto sales, and commodities as being the three elements. But those three don't really reflect the services industry, and the services has been the sticky part. And she didn't really address that at all, which I thought was odd. So the sticky part of inflation is in services, and what's going to knock that down. Meanwhile, she doesn't also mention that we've just begun to see a little bit of inflation in goods. So after having no inflation in goods, but heavy inflation in services, now we're starting to see a little bit of a inflationary pressure on the goods side. So it's a little hard to see how inflation is going to come down, at least in this 6-month period that we seem to be talking about.
Yeah, and there are other factors as well. And so let's have a look at them. So if we look at the yield curve, we see and I didn't have a takeaway here, we see that the yield curve is actually still a negative. What does that mean? It means that the difference between what the Fed is charging in interest rates and the and the market is paying for 10-year treasuries is really very significant. I mean, we're paying 5%, 6%, well, 5%, 4.5% to 5% for 10-year treasuries, and yet short-term assets like 6-month deposits or even call money is earning more than these 5-year, 10-year, and 15-year bonds.
Right.
So that indicates that there is still enormous pressure in the marketplace, and the market is not yet comfortable that we're on a path to some resolution.
Right.
And so it's not a good situation. Now, if Cathie's right, this should drop quite significantly in the near term.
But what we should be looking at is what we see is that before every recession, this begins to, I mean, it's already begun to go up, if you will, up, meaning that the yield is shrinking. I mean, I'm sorry, the difference between the 10-year and the 2-year is shrinking. So that's already happening. We cover this every single day on my program. In fact, twice a day, morning and evening. And it's shrinking, but it hasn't shrunk to zero, and normally it would be positive. So what we're looking at here is before each time that we've started to see this recovery on the yield differential, that's when the recession has started. So this would be a very big pointer towards a potential recession.
Right. And the question is, does it happen every time? And it looks quite serious in terms of the pattern from the past, right?
Yes.
There's almost no time that we haven't actually had that transition where we haven't had a recession. But, time will tell. Time will tell. So now we look at the federal funds target rate. And Cathie says that if inflation comes down to ARC's expectations, real rates go to 5%, a condition not seen since the 80s recession. So again, if inflation comes down, right now it's considered to be about 3%. If it comes down to 2.5%, then the difference will be 2.5%, and this number jumps up to 5%. This 2.5% real funds target rate, instead of the target rate, which is 2.5, the actual reality will be it'll be at 5% because of the differential in the real rates.
Yep.
So that's the danger point, and that's what Cathie's calling at. And so the question is Cathie right or is the Fed right? That's the continuing question. And this is a slide that Cathie introduced this particular Employment Friday, because this is actually prepared by Morgan Stanley, and Bloomberg published it. And they have this chart of the length of time from the last Fed rate hike to the first cut. In other words, the Fed raises rates
Mhm.
in order to reduce activity and to counter inflation. And then it has to start cutting again those rates because they're unnaturally high and they have to cut them down. And the question is, from their last raise to their first cut, what is that length of time? And you'll see these are the average lengths. These are the lengths of time, and they range from 4 months to a low, actually 3 months low, to a high of 18 months. And they just show that in these very significant years, 24, well, leave out 24 for the moment, but 69, 70, 97, 98, and 206 and 06 and 07 were precursors to major financial crises.
Right.
So the 70s, that's 10-year long recession. 1997, 98, that was the global financial, no, that was
That was a dot-com bust.
the dot-com bust, and 2006, 07 was the global financial crisis. So, the longer it waits, the worse the potential crisis that comes. And right now, we are above the sort of breakpoint line that Morgan Stanley drew. We're at 10. We're not as bad as the 15 or the 18 that happened before those major crises. But, if the Fed is only going to cut in September, which is the current skinny on the market, that would take us up to 14 months.
Yeah, and she didn't even point out that if you look at the two that are 8 months, that was the 2001. That was also that was what was called the manufacturing depression, where
Right.
the headline in the LA Times was manufacturing's off 25%. In 1 month, it went down 25%. It's crazy. And then the 2019 was just before or well, actually, that would be after, I suppose, the 2018, 2019 kind of problem that we had that caused the slow economy of the 20s. So these are not even those were problematic.
Yeah, I think the 2019 less so than the 2000, but
That's right.
as you
Yeah.
say,
Right.
the longer that they delay, the more they seem to overshoot to the
Right.
negative side.
Right.
And that's what this slide is telling us. And we are now in danger territory.
Right.
So now she goes on to fiscal policy, which is all about the budget and the government's handling of money. And we start talking about the federal budget deficit and surplus as a percentage of nominal GDP. So if you look at the periods of recession, which are the gray periods, they always tend to occur when the government expenditure is turning down significantly. It's almost a pattern. You see it, but almost every time there's been a significant reduction in the surplus or in the actual or an increase in the deficit, significant increase in the deficit, there's been a recession. So the question is this a potential period of recession? That's unclear. It's not actually as clear as one would make out. But what Cathie does say is that the solution to deficit is growth. Technology can save us. If you look at the thousands, that was the period of 1990, the internet and the PC revolution and email connecting to the internet, or the internet actually becoming, the basic replacement of a communication system in the world. It was an enormously profitable period. And the question is, are we going through such a period again?
Right.
Yeah, I'm a little skeptical of this because the pandemic really was the interfering factor here. If you take the pandemic out, you really were still on the way down. And the question is, is she right? Is that crisis, is that revolution coming soon enough? I think we are always anticipating events sooner than they tend to occur.
And I was shocked by the productivity number last week, only being 1%, a 0.1% gain month over month. No, yeah, 0.1% month over month. So that was, I'm wrong on that. 0.2, I can't remember, but not nearly as high as it had been in the prior quarter. I want to say, I think it was 1% for the quarter. That's what it was.
That's what it was, yeah.
Versus 2.8 or something like that. So yeah, that was a very low productivity number. That was surprising.
Yeah, and so I think these things take time, and the AI revolution. I mean, we had this conversation in a conference call just yesterday. People tend to anticipate these revolutions much shorter period of time than they really occur. And it takes time for it to mature, for the infrastructure and the reorganization of enterprises to take advantage of it. So I think we're a little ways away. I personally think we have some tough times ahead for a couple of years.
We'll talk about this a little more with the employment numbers, but I have my pet thinking, my pet reasoning, which is that these big, and in fact, from big to small, all companies are still reluctant to lay off. They just are afraid to lay off. They've just trained these people. They think the economy is going to be okay, and they're reluctant to lay off. And that, I think, is what's holding up this productivity opportunity.
Right. And so we can look at some of the economic indicators. And here we have consumer sentiment versus expectations, the University of Michigan review. It's up. We're getting, above the sort of magic line, but Cathie expects unemployment to grow, as do you, as do I. And so we'll probably see a decline again back below the 80 mark, which is, a fairly critical point in terms of when consumer expectations and consumer sentiment really, starts powering the economy.
And also, there's more than one consumer sentiment survey, and the other consumer sentiment survey that just came out last week was not nearly that positive. It was much more negative.
I think I have it a little bit later in the
Okay, all right.
This is the indicator that Cathie spent quite a bit of time on, and that is same-store sales in restaurants, year-over-year percentage change. And she said this is a very strong harbinger of the future. Now, she says that, if you look at the, other than Chipotle, which kind of almost kept at this sort of 10% mark, all the others are dropping below, well, except I guess Starbucks is dropping, but not quite below the 0 mark. But actually, if you look at Yum and McDonald's, they're below the 0 mark.
Right.
That's a very unusual situation, and it occurs in times of great stress.
And an interesting thing here is that we're not really hearing this in terms of upscale restaurants. It is the fast food restaurants that are getting slammed. Their prices have gone crazy. Their prices are super high. And who's going to be the most likely user of this would be the middle class. And they're the ones, I think, that are struggling to try to actually make the monthly bill. So right now, again, I think this is exactly as you're pointing out. I think people are starting to put their hands in their pockets. I don't think there's any doubt.
Yeah. So now we can talk about employment, and we're looking at, a fairly dramatic drop in household employment. And, you know, that's the harbinger. I mean, that's the leading indicator. The government employment figures lag that. They're probably overstated. There've been constant downward
Downward,
revisions.
yes.
There was another 22,000 this Employment Friday. So, you know, people, I don't understand the optimism right now. I don't see this downward curve as being, you know, a basis for optimism. I mean, we're almost at the zero mark for household employment. That's, you know, that's a really bad situation. And that probably indicates that that purple line is going to drop quite significantly very shortly. So,
Yeah. And Larry, I don't know if you happen to notice, nobody that I saw reported on this yesterday. One of the big stories on the employment number had been full-time versus part-time. I didn't notice, and I looked at the actual report yesterday and still didn't see it, whether full-time employment saw any uptick at all, or whether it's still all about part-time employment. Did you happen to notice?
I didn't, because, you know, to be honest, I was in a tour bus.
Yeah, tour bus. There you go. Yeah,
Thank
I'm a
you.
little bit on a tour bus myself. It just
Good, right.
happens to be a
Good
rental
train.
car instead of a bus.
Yeah. Yeah, this tour bus was a train, but nonetheless, you get the picture. Yeah. So temporary help, which kind of talks a little bit about that, you know, the temporary help continues to decline, while non-farm payroll apparently continues to rise. So, you know, that's kind of an indicator. I think there's a break point, you know, at which point, you know, and we see generally that temporary leads, you know, permanent.
Right.
So we'll see.
Yeah. So I mention this every month, but there could be people on here that are new to this. I'm a big advocate of temporary employment. I studied it. I used it 100% for my business in terms of hiring. And I think this is an anomaly. I think this is an anomaly about what we talked about a minute ago, that employers are reluctant to lay off, so they don't need temp help right now. They can just shuffle people around. Typically, the temporary help is seasonal, or you're in a growth curve and you don't want to necessarily hire permanently yet. This is not the market for that. I think this is an anomaly. I think we'll see years from now, we'll look back on this and go, oh, this was an anomaly.
Yeah, yeah. It's interesting to me though that so much has changed because of the pandemic, and the
Yes.
question really is, how do you measure anything when these anomalies are still bouncing up and
Yes.
down?
Yes.
So I think that's just part of that same syndrome, right?
Yep.
So quit rates. So quit rates, you know, if you look at the JOLTS quit rate, I mean, it's so these are not the same time. There's a leading by 9 months, so the quit rate has been moved up 9 months, right?
Okay.
And if you look at the quit rate versus the job index, the quit rate is going to lead the employment cost index. So it looks to us like the index is going to decline quite dramatically to where it's actually, you know, getting down into the recession levels. You know, it could be that it turns around about this point, but if it doesn't turn around this point, then it'll be below the norm. It'll be, you know, we're back to the 2010 global financial crisis level. So you really don't want to get much below this point, and we're at that point where we don't want to get below. So that's really where we are. It's a very sort of critical point at which we're at.
Yeah, and again, let's put some color on this. What we had during the global pandemic was we had no employees. people couldn't find employees to save their life. They couldn't find skilled employees. So they were willing to pay a lot of money and give them a lot of benefits in order to come to the
Yeah.
company. People were quitting like crazy. They would come to work for a month and then leave, and because somebody made them a better offer. That again was completely out. You can see how much higher that was than any historical idea of what would happen on the quits rate. So that's coming down radically because why? Because companies are not in that same frenzy to hire. And employees are probably saying, hey, I kind of like this job. Or even if they hate the job, I don't see the opportunity. I'm not getting those calls anymore from the headhunters offering me a lot more money. There's always going to be a limit to these kind of extremes. And I think that extreme has been met. Now, by the same token, I think we're getting to the place where some of those people are being paid way over what they're worth. And so there's going to be, I think, some consequences to that. And that is what I think you're going to see next.
Well, it's a critical point. So again, we just don't know what the anomaly of the pandemic, what the impact of the anomaly of the pandemic is. US savings rate are dropping like a stone.
Yes.
And that's not good because we're reaching 08 levels, and we know what happened in 08. That was a pretty catastrophic event.
Cathie made a super interesting point. She said the people are not they're not borrowing against their home. They're not going after the home improvement loans or whatever in order to hold on to their savings rate. They're not continuing to contribute to savings accounts because they're having to dig into their savings rather than go into any kind of a mortgage. And that's because the mortgages are so high. Now, the mortgages are not historically high, but if you're sitting on let's say you're older now, you're much older than you were 10 years ago when the last time the savings rates were high. All of a sudden, you're 10 years older, you're less likely to dig into that home for, get a mortgage.
The other color I'd add to that is that such a large proportion of homeowners or boomers and people of advanced age, they would never they would not, they're probably paying off their mortgage rather than dipping into their mortgage.
Right. Yep.
So that actually the savings rate decline could reflect the retirement of those people versus the lack of savings of the younger people. So
I think it's at least a part of it. Yep.
Yeah. So the demographic shift really, is a thread that runs through all of these economic slides. So, and it's difficult to tell how much is the impact of the demographic thread. So that's an offsetting factor. And then we get to US existing home sales, the volume of sales, and we see we're at almost at an all-time low. If things get any worse than this, we may actually hit the 2010 crisis level.
This one and the next one, I don't think we can really add this to the subject matter of recession. This is all about supply. The supply is still extremely low. And there's a few comments on X over the last month or so showing that there's a little more inventory on the market. Well, there's always more inventory on the market in April. Now we have to see what happens in May and June, whether the inventory gets sold like it usually does in May and June, but it's still not going to be big numbers because there's nothing to sell. And that's true also for new homes. They're just not building a lot of new homes, so there's nothing to sell. So this is not, I don't see this as at all reflective of a potential recession, other than the fact that because it's so low, nobody's buying the stuff they buy. Well, they're not paying the real estate agent, they're not paying the mortgage broker, and they're not paying for the stuff after they buy the house.
And there's all the expenses, the cost of repairs and maintenance and new additions that happen that accompany buying the home. So there's a lot of economic activity that declines when existing home sales decline a lot. And so what's interesting is one family houses sold. I'm actually surprised that it's holding up as well as it is.
Yes, exactly.
But, I mean, it has to be low simply because of the interest rates. We should have a conversation about interest rates one day, maybe not today, but interest rates are actually, despite them being high in our consciousness, they're not that high traditionally.
No, they're actually almost exactly average.
Yeah, yeah. So that's interesting. And also interesting is auto sales. The question is whether the 15 million that we're down to represents a new norm, a new normal, or whether it actually is reflective of, tough times, tough financial times. I think
So
there's a combination here.
yeah, I think so too. I will say once again, I always having been in the bicycle industry my whole life, we always looked at the bicycle sales and the car sales in terms of following the same line. I don't know if I could find a chart for that, but they were almost always were up and down about the same rate. And what we see right now is bicycle sales are tremendously depressed. And I think this is more of that consumer just doesn't want to stretch right now. They just don't want to go out and buy that car right now. It's just uh, too uncertain, and their budgets are stretched.
And you don't think it has anything to do with the availability of Uber and Lyft and
I do. I think that's contributing a lot, and I think it's also partially due to the fact the cars last longer.
yep. So
Oh,
you've got
and people working from home. That's another factor.
so you have multiple factors occurring at the same time.
Right.
And the I was going to say that the population is not growing as fast as it used to, although with the immigration we're having right now, legal and illegal immigration,
Right.
I guess those people are not yet affording cars, but it'll come. Small business optimism index. This is not looking good, I have to say. I mean, for a while it held up there, but right now it's not looking good at all, Randy. And
Yeah, so I spend a lot of time every month looking at this particular report, and Cathie got it wrong. She said that that their optimism or their lack of optimism was due to their inability to find financing. But as I reported last month and the month before, only about 3% of small businesses are concerned at all about finding financing. And this is I've worked with over 400 clients over the last 16 years. And my understanding of the small business owner is that they're 55, they're now 55 years old. That's the average of the small business owner. They have a home paid off. They have a spouse that's working and also has medical insurance. They are not worried at all about having to borrow money to grow their business. Even the larger small businesses are in that same situation. And so the report is, nope, they don't need the money. What they're concerned about, the reason their optimism is so far down is they can't raise their prices anymore. Their costs are going up, even though they can't raise the prices. They still can't find qualified employees, and they're worried that the future is not going to be better.
well, in a way, what you're saying, and by the way, you're the expert in this field, so I defer to you, but what you're saying is actually more serious than what Cathie saying.
Yeah. Oh, no, it is. Yes, you're right. It's absolutely more serious.
Yeah. So that's very interesting. Well, on to the Chicago Business Barometer, and this is nasty. This is why, this particular report is serious to me. I mean, when you see the business barometer getting down to these levels, it's almost always accompanied by a recession, if not always recover. I mean, just look at this chart. It's without doubt, something happening. I mean, when you look at the last blip down back in 2023, at the beginning of 2023, you can see a very rapid recovery from it, and it actually got into positive territory. But now it's all the way down to, probably red line territory. And, if we see another report like this is pretty indicative of a recession.
Right, and this is the bigger businesses. So as opposed to the NFIB report, which we
Right.
talked about earlier, these are the, the middle-sized businesses, even the small caps would be included in this. And every evidence is that the small caps are not doing well at all. They just aren't doing well at all. The S&P 500, all of the action is in the top six.
Yeah.
And in the Russell 2000, same thing. You've got very poor numbers for the mid caps in terms of earnings. So they report exactly the same thing as the small business owner. Well, not exactly the same thing. They're not complaining about employees anymore. They are complaining that their order books are not full. Their shipments are going out the door faster because they've got plenty of inventory. So no, this last report from the Chicago Business Barometer was really not good at all, and it was a very sharp spike down.
Yeah. And it came from a very sharp spike up,
Yes,
which one wonders whether that wasn't all the optimism generated by the, oh, they're going to be 3 interest rate reductions this year and blah, blah, blah. But I think that there was this false dawn, and, who knows, but that spike was really very, 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 very short, and the general trend is very, very much down. And we've never escaped a recession. Well, maybe in 2016 we escaped a recession when we hit that number. But then again, it was also a short spike. So this is something we'll have to keep a very close watch on.
right.
So then market signals, and we start with the dollar index. The dollar remains strong. And by the way, when the dollar's this strong, it's not that exciting for the economy. I mean, strong dollars are not necessarily related to strong economies, by the way.
Yeah, not necessarily, but this one seems to be, because we have, I think nobody would question, without giving any credit to the administration, that the US economy is the envy of the world right now. There is no other economy doing as well as the US economy. And I'm sure that you are enjoying the luxury of that strong US dollar in your travels in France, just as I was in Canada. I was amazed at how far my dollar went in Canada. So, but yeah, this does seem to be probably evidence of our strong economy by comparison to the rest of the world. Not necessarily because it's that great, but by comparison to the rest.
Yeah, can you imagine what's going to happen globally if the US economy falters at this point?
Oh yeah, not going to be good.
And you only have to look at the dollar Japanese yen exchange rate, to see that for so many years, the exchange rate of the yen was the envy of the world.
Right.
And that declined very dramatically after 1985 and, into the 90s, 95. And, here we are again, with the dollar climbing back against the yen.
Well, we've talked about this before, of course, that the Japanese population is declining rapidly. We've talked about whether that's an impact. They do seem to, their economy seems to be okay right now, not great. Again, going around, a 0 to 1% increase per year, but they've had to intervene twice in the last 2 weeks. The Japanese central bank has had to intervene twice in the last 2 weeks just to keep it from getting worse.
Isn't it amazing that they actually can grow 1 or 2% a year when their population is declining at this rate? I mean, you have to say these guys, really do work hard at it. But I mean, the demographics are just,
not good.
They control. The demographics will control. So finally, the Japanese are permitting immigration. So we'll see. It'll be very interesting what happens socially in that country. The commodity index, again, Cathie points out the commodities really, in real terms, have not changed in price. So being stable in real terms, the threat, she says, is non-inflation, it is deflation. Hard to gainsay that here if you look at this chart.
Yeah, I think it's clear that the commodities are not, but what I've thought about the commodities is this could be the problem the Fed is most worried about because they're so deflated that if the commodities become the next place that people want to, in other words, if you have anytime any market swings too far in one direction or the other, then some people get greedy or they get scared, one or the other, right? So there could begin to be a situation where people are like, okay, commodities are the next opportunity. Then you start to see some bargain hunting. You might see the beginning of the rising of the commodity prices, and that would cause, of course, an overall rise in prices. So it could be an issue for the Fed.
But that's upside down, surely, because if people wanted to invest in commodities and buy up commodities, that would lead to, them sitting on huge. I mean, what are you going to do with that commodity?
Well, it's got to have a place to go. Yes.
If that commodity is not used for production, you're wasting your money.
Right. Right. Yeah.
So,
that's absolutely true. Yeah.
So I don't see, famously, the Hunt brothers tried to capture the silver market because they thought it was so cheap, and it bankrupted them. So that's the problem with commodities. They're only useful to the extent that there's demand for them in the marketplace.
So on that basis, we also, I think, very quickly, just gold, silver, and copper are all three screaming higher. The rest are not. So it's really just those three. So gold, of course, a traditional flight to safety. Silver is actually up over the last 2 years more than gold. And copper is up more than either one of them, and it's very close to all-time highs. Gold is at all-time highs. I'm not sure if silver is at all-time highs, but I think it might be also. The copper is only, I don't know, 20 cents away from all-time highs. But the copper situation is related. I finally did dig deep into it. It is related to the lack of copper availability for electrical products. There's one in particular, I even forget what it is, but there's one particular item right now, they just can't get enough of these items, and the copper is the component that's missing. But long-term, the copper market is looking at this massive build out of the data centers and recognizing that there's going to be a long-term demand for copper.
Yeah, I think copper is an essential component of transformers. Very significant amount of copper being used, and transformers are right now.
Right.
They're the bottleneck on building out data centers. So that's probably it. So that's an anomaly, but we'll see. I mean, normally copper actually is a predictor of the canary in coal mine. So we'll see. I mean, that's a very interesting observation. But if you look at commodities right now, they're sitting at 100, and if you look at them in 1980, they were at 100. And that's, by the way, not inflation adjusted.
Yes, right. And and by the way, I also dug into that a little bit. Part of that is the ability of industry to extract at a lower cost. So there has been some of that.
But that's historically true.
Yes.
The cost of mining for iron in 10 BC was very significantly higher than it is today, So yeah, and then the metals gold ratio. Well, this is
the one that just I can't figure it out. She didn't have a good explanation. I don't have any theory on this one.
Well, the reason it's departing is because the rise in the price of gold. The rise in the price of gold is almost directly related to the departure of many of these countries from the dollar standard, Russia, China, and their friends. And so when you get a marginal increase in the demand for gold, you get a massive spike in the price of gold. It's demand and supply.
Sure.
the gold supply does not react very rapidly to increase in demand. It could increase recovery, but it takes 5 to 10 years. So whenever you get, a huge change in consumption, you get this impact on the price of gold.
So Larry, it turns out that the central banks had been selling gold over the last 10 or 20 years, and their gold reserves got to the lowest levels that the central banks had ever been. And now the central banks are buying gold. They're now buying gold because whether it's a dollar thing or whether they just felt that the reserves were too low on gold, whatever reasons that are
No,
out.
it's a dollar thing. It's a
Exactly.
dollar thing. You look at the rate at which the US have been using political means
Mhm.
to implement its policies
Right.
against potentially unfriendly nations.
Yeah.
And you trace that to the rise in the dollar reserves. I mean, there was a point, when we were talking about the flat Earth, and we were going to spread the supply chain to all these less expensive countries and so on and so forth. Everybody was happy to hold dollars,
Mhm.
and the world was flat, and gold was going to disappear.
Mhm.
Nowadays, you have no longer a flat Earth. You have, multipolar world. You have, the BRICS expansion, and you have Russia at war with Europe, at war in Europe and
Mhm.
with Europe and with the United States. You
Mhm.
have China as in, detaching, or the US detaching from China. So there's this return, or not return to gold, there's the flight from the dollar.
Right. And you also, by the way, have the Chinese consumer, the individual buying a lot of gold, and
Yeah.
the US consumer buying a lot of gold. So that might be impacting the savings rate also.
I would like to see the numbers on the US buying gold, but certainly the Chinese public are buying gold, and for very good reason.
Yep.
Yeah. Yeah, and then investment grade versus high yield index credit default swaps. Yields are gapping. And actually, Cathie thought that the yields should gap even larger.
Right.
I would be surprised, actually.
Yeah, I mean, this would be not suggesting a recession. This would be suggesting that banks are pretty happy with the quality of their loans. And so the insurance companies are, I guess, not the banks so much. The insurance companies are happy with the quality of the bank's loans. So the interest rates are coming down. This would not be recessionary. We were seeing the spike up just, a couple of months ago, 3, 4 months ago. We were both talking about it was spiking up, but now it's relaxing again. I can't, I know I harp on this a lot, but I keep thinking that these mid-sized, all the companies from the smallest to the biggest have been planning for a recession now for 2 years. So they've got their houses in order. They've got their,
Well, interest rates were at zero, right?
yeah,
So you had to borrow as much as you could
yeah,
just to keep up with your competitor, who was borrowing as much as they could, or getting as much liquidity as they could at these very low interest rates. But when do those loans run out, and when do they have to refinance? And what happens then? I don't know. It's interesting.
yeah, but were they borrowing? Larry, were you borrowing? Was your company borrowing as much as they could?
No.
No,
Oh,
see,
actually, let me rephrase that. Actually, we went to the markets. What year was it? Not at the bottom of interest rates. We went to the market simply because our balance sheet was so good that we wanted to take
that's
advantage.
my point. The balance sheets are so
Yeah.
good. I think, and the balance sheets even got better, even though their sales are not great, their balance sheets are great. And I think that's what's happening. I think that's an argument that would stand if we went even deeper and took a look.
Mm. That's a good point. It's a good point. You know, when you go through these anomalous times, anomalous things happen that are not easily explained by prior history, because
Right.
it happened in anomalous times. I think that's what we're saying. It's an interesting point. So now we get to your point about, you know, the concentration of value in the market in just a few stocks, and how, you know, the S&P, even in the S&P, all the active shares are around, you know, just a few counters. I talked about the Magnificent Seven or the Magnificent Six, but active shares in the NASDAQ went from 87% were active down to 55% are active. So where are the innovators?
Yeah. And we talked about this on a show earlier this week, and I think you and I might have talked about it a month or so ago. We also have companies are not going public.
Yeah.
And so this is probably also having an impact. We have the least number of public companies ever, I think, as a percentage, maybe even as a total. There's not even enough for the Wilshire 500 to find 500 companies to put on the, or, I'm sorry, the Wilshire 5,000. There's not 5,000 companies. They can't, there are not 5,000 incorporated public companies. So this is another impact on the activity of
Yeah.
the bid caps.
Yeah, no, you're right. You're right. And, you know, why are companies not going public? Because such a rich venture and private equity market, and because people are really tired of regulators, and the complexities that the regulators have imposed upon companies. And
Exactly.
so it's a very rich private market in venture and private equity, and so, you know, that is making a big change. That's making a big change. And then we have the weight of the top 10 stocks. This is the same problem. You know, the question is there going to be a breakup of these companies?
Right.
And I think a lot turns on the next election, right?
You bet.
And then the final slide of a long deck, and a lot of time, and we've been at this for over an hour now, is the market cap to the largest stock relative to the 75th percentile stock. This is really the same story. It's,
Yes.
you know, it's the question of concentration into this, into these companies. But what this slide shows is that when we reach these levels of concentration, and we're at a level we've never seen before, not in 100 years, almost 100 years, well, actually in 100 years,
Yeah.
when we reach these levels, they generally portend some sort of crisis. Now, there are a lot of slides in this deck that shows when crises are portended.
Right.
So I think, you know, some of this has to do with just, you know, the coincidence of numbers, but this looks pretty indicative, right?
Yeah, I'd be hard pressed to figure out why it would be this time. The concentration is in extremely well-run, extremely successful companies that have been successful over many years now. You know, sometimes those successful companies run into a change of leadership, that they're not so successful over the next 10 years or whatnot. But man, it would be hard to. I'm trying to imagine the circumstances where these six companies, well, I quite frankly think, I'm sure you do too, that Tesla should still be a Magnificent Seven, even though it's had 5 months or 5 quarters of less magnificence. The future bodes extremely well for Tesla. And you look at those seven companies, it's hard, and a few under them, you could go down to number 12, 13, and try to imagine what would be the problem for those 13 companies.
But yeah, I think you're pursuing the wrong rabbit.
Okay, all right.
So if you look at these periods, or these times where you get this level of concentration, and they peak times, they actually the companies that were at the peak, that were responsible for those peaks, were not the companies that had the crisis. So if you look in 1932, which were the peak companies, it was General Electric, it was Standard Oil, it was the massive companies. They never had any problems in the crisis of the 30s. The same is true if you go to the companies in 73, or you go to the companies in 2000. Those companies that were the constant where the wealth was concentrated or the market cap was concentrated.
Right.
They didn't suffer from the crisis.
Actually, I think Cathie pointed out that this is not so much a matter of a crisis. This is a matter of a broadening out of the purchasing of stocks, so that it wasn't that the big companies came down, it was that the mid caps and the small caps came up. It brought the market broadened, resulting in not such a high concentration at the top because it was a broader market. I've been looking for this broadening out now for over a year. Keep asking, when is that going to happen?
Yeah, but these peaks occurred just before crisis.
I know. Yes, I know. I noticed that. Yeah.
So why would that lead to a broadening out?
Yeah.
I think it leads to a culling of the smaller companies and the rise of new companies.
Yeah. 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 Interesting.
Needs some study.
Needs some study. All right.
As does everything else we've touched on, because everything we've touched on could be looked at in two ways. On the one hand, and then on the other hand.
The other hand, yeah. So right now I'm at a 30%. Here, Larry, my problem, I raised my number again to 30% chance of recession in the third quarter. Do you know why? But do you know what the number one reason why he was even questioning it this morning before we started is usually that recession is going to be the number one thing I look for before a recession is the market to come down 10 or 20%.
Yeah.
And that hasn't obviously happened. The end of the week, it went back up again, not even starting to go to my 10% correction.
Yeah. Well, I think that if I continue to predict a recession, I'm going to be right eventually.
You're probably 100% right on that one.
Yeah.
Okay. Well, let's also predict that Tesla is going to knock it out of the park over the next 30 days.
You're always focused on the next 30 days. And I just don't understand that, because we know that there's going to be a challenging period between now and the time that autonomy actually takes off and that the Model Next actually is on 4 wheels. And so, I know that, that's the hallmark of your channel, and you love to say, well, next week, Tesla's going to go to 300, 200, 300, whatever the current market is. I don't think we're going to see such growth. I think we're going to such an immediate impact. I think that the takeoff takes place, as I've said, for the last year or so,
right
towards the end of this year, the beginning of next year. I'm very, very optimistic, very optimistic. But we've got some crises to get through. And the first is the shareholders vote in June for the reinstitution of Elon's pay package. And it's very important that everybody vote. Very important. And then there are, several other crises to get through, not least of which is the one that Elon has generated right now, and which is, he's changing the business. He's changing the business. He is completely, taking it apart and putting it back together again, and probably the right time to do it. And people will look back in 2 years, 3 years' time and say, wow, what a genius move.
Yes.
But right now, they consider it a disaster.
Yes.
So those are the things we have to get through, and they're not good for the share price.
Right. Larry, as always, thank you so much. This is my favorite meeting that we do every month. In fact, it's my favorite show that I do every month. And hopefully the folks enjoyed it. Hopefully they've got some comments to let us know where we probably got it wrong once or twice, where Cathie might have gotten it wrong once or twice. I'm not above, as you can tell, saying that Cathie got it wrong. Maybe a couple of things where we just missed entirely something that should have made a contribution to the conversation.
Yeah, and I will end on an admission of guilt. I really didn't prepare sufficiently for today. I came unprepared.
I think you did just fine, Larry.
Thank you, boss. Thank you.
All right, okay. Thank you so much, Larry, and to all of you out there, as always, it has been great talking to you.